A new client who's 1 year out from retirement said to me, "Anthony, I know we probably need to sell our stock since I'm retiring, right?" I responded, "No, it's not what you think." In this video, I'll share what I explained to my client, including why it's even more crucial in retirement to get the investment allocation right so you can reduce risk but not give up the growth. We'll walk through an example investment plan and the simple system you can use to keep the plan going throughout retirement. So to create an investment plan that's right for you during retirement, you first need to understand why investing is different once you retire. When you're young and first start investing, people often think they need to time their investments perfectly. But the truth is that when you're building wealth, it doesn't matter all too much when you put money in. I'll show you what I mean. Okay, as you'll see on this chart, Portfolio A has great returns early in life, but then bad returns when you approach retirement. Portfolio C, on the other hand, has bad returns early in life, but then good returns when you approach retirement. Then there's Portfolio B, which has the exact same return of 7% every year. Okay, all three portfolios, A, B, and C, have the same average annual rate of return of 7%. So if you were to start investing at age 40, it really doesn't matter if you have good returns early and then bad returns later in life or the other way around. Over a 25-year period, you end up in the same spot during the saving phase of your life. But the story is much different in the income stages of retirement. Again, let's assume the same portfolios and the same pattern of returns. In all three instances, this retiree started with a retirement of $1 million and needed $60,000 of income annually adjusted for inflation. Portfolio C, the one that had negative returns at the beginning of retirement, actually ran out of money before age 90, whereas Portfolio A, that had the positive returns early in retirement, actually had more money than they started with. And again, all three portfolios had the same average annual rate of return, but when they earned those returns was quite different. This risk I just illustrated is called sequence of returns risk. It simply explains that in the income stages of life, early returns are more critical to the outcome. But because we cannot control the direction of the markets, whether you're getting ready to retire or you're retired now, you have to consider a possible downturn in the market. So like my client, maybe you're thinking, well, we can just get rid of the up and down risk of stocks. Let's put our money in CDs and earn 5% interest. That sounds pretty good. But here's why that does not work. Okay, this chart compares the growth of a dollar in stocks, bonds, and cash or treasury bills, and it goes back 100 years. Granted, this is an exceptionally long period of time. Cash and bonds do slightly outpace inflation over that 100 years, but stocks, which are broken down by large companies and small caps, significantly outperform bonds and cash. Now, our retirement years don't span 100 years, but even in a normal retirement timeline, the compound growth effect is very real. But to get those stock returns, we have to deal with the sequence of returns risk that I showed you. So is there a way to invest in stocks to get growth, but also minimize the risk of sequence of returns? The stock market in any given year is subject to a very wide range of outcomes. The largest single year decline going back to the Great Depression was negative 44% in 1931. And in 2008, a little more recently, it dropped over 36%. The largest increase, however, was over 52% in 1954. But with all the ups and downs, watch what happens over time. I'm going to use Ben Carlson's research. Okay, so if we go over here to the 10-year returns, these are rolling returns, we can see that there's a few low points where the stock market over a 10-year period was negative, going back to the late 30s, and then which is the Great Depression, and then also around even 2008, which is more recent after the Great Financial Crisis. And then earlier in that decade, when you're looking at that 10-year return getting to 2008, we had the tech bubble that was bursting. But in most 10-year periods, the stock market was overwhelmingly positive. Okay, so how about 20 years? If we scroll down here and we see 20-year rolling returns, we see that no 20-year period was below zero. The lowest average return was around 2%, but still positive. Now, how about a 30-year rolling period? The lowest average return was 7.8%, again, on average. And that was with the period starting in 1926. So even with the Great Depression, the cumulative return was 850% over 30 years. Time really does become your friend because it reduces that risk. So now you might be wondering, okay, if we can get growth from stocks given enough time, how do we deal with the second part and address sequence of returns risk? Well, the biggest mistake people make, in my opinion, is basing their allocation of investments on risk tolerance alone. Let me give you an analogy. Let's say you're somewhat skittish about flying in an airplane. If you called the airline and said, I'd like to take a flight that only goes 5,000 feet in the air instead of the normal 30,000 feet, this way if the plane has an issue, I'm closer to the ground. Well, in reality, we know that flying that low to the ground would bring another set of risk. If you're a nervous flyer, you can reduce the frequency of your flying in an airplane, but you don't want to fly wrong. In investing, if you own growth investments like stocks, you may not hold as much stocks as an investor who doesn't worry about the fluctuation. But in either case, you want to hold them the right way with a solid plan and not submit yourself to unintended risks. So to be a better investor in stocks, you start with a strong foundation. This includes your first bucket, which should have cash like money markets or CDs for your current income needs. We like to have a year of cash, but if you want 2 or 3 years worth of an income in that cash, that's okay. Then bonds make up bucket number 2 for short to intermediate needs. If you have really short, high quality bonds, that may mean a little less in cash or vice versa. Thirdly, you have a long-term bucket for stocks. This is your growth engine that will fluctuate, yes, in the short term, but the key is you don't need it anytime soon. Remember, the risk can decrease over time as the range of returns tends to average out. Now, if you're more aggressive, maybe this bucket is to be used only 3 years from now. But if you're super conservative, maybe that's 20 years away. Now, if you're going to spend down the cash bucket, how do you refill it? We do that through the process of rebalancing, which is just a way of saying that we move back to our targets. You can rebalance at a regular time each year. We rebalance based on relative tolerance bands, which just means when an investment gets too far away from its targets, we have a notification to bring it back into balance. You can see from this research by Michael Kitces that the most optimal for rebalancing based on these drift is allowing a specific investment to move away 20% above or below its target percentage. Let's walk through together a simple investment plan with $1 million, and let's say you need $50,000 of income from the portfolio each year. If we want a year's worth of income in cash, we add 5% or $50,000 into a money market fund. And let's say you want another 6 years worth of income into bonds. Well, that's $300,000 or 30%. Now, this info may help as you decide. The average bear market in stocks lasts 338 days, just under a year. And even after the average break even from the time the market starts going down until it recovers is just over a year and a half. So 6 years in bonds in this example would be a healthy cushion of time. So that's 5% in cash and 30% in bonds, and that leaves 65% for stocks. And the beauty of it is you can customize this as you like. So what rebalancing does is it naturally takes the profits from whatever's over the target and refills the other buckets. Typically, as you're spending down your cash bucket, you refill it with bonds or stocks as long as they're growing or at least they're holding their value. Now, in this scenario, when stocks go down, because we know that they will fluctuate, you may be buying more stocks at lower prices. In either case, setting up a foundation of cash and bonds for income can prevent you from being forced to sell stocks when they're down, and therefore you're minimizing that sequence of returns risk. And now that your allocation's set up, you might be wondering, which account do you withdraw from first? Well, Alex recorded an entire video called Where Should I Take Money From First in Retirement? You can check that out here or in the description below. And if you're interested in me or one of our CFPs from my team helping you with your retirement portfolio, you can schedule a call at onedegreeadvisors.com, which is linked in the description below. Catch you on the next one.